Hello and welcome to the second episode of Intimate Investing. It's now been 3 weeks since my last video and a month since I've started investing. I'd originally planned to do the videos once per week, however I thought that since I was quite early in actually building my investment portfolio, that it'd be a better idea to just wait till I had a small portfolio built up, and then it might be slightly more interesting for the viewer to watch. So I created this Freetrade ISA account on the 1st of April. The first deposit was on the 2nd of April, and it's now the 1st of May. So it's now been a month that I've been investing for and using this account, and we can just sort of take a little look back at how it's grown, what my contributions have been, what my allocations have been, and what I plan on doing moving forward. We'll start with the first stock, which will be Aviva. Now, this stock, I've increased my position from 66 shares to 202 shares. My average price previously was £2.64, and I managed to take that down to £2.51, which is a reduction of 4.93%. So I've been investing quite heavily in Aviva. When I had started allocating funds towards it, it was sort of, if you take a look at the right-hand side at the very end of that chart, you can see the three spikes at the very end. And I mean, at the high points they're at £2.68, and that was around the point that I'd originally started investing in Aviva. So I mean, I've been trying to average down. I have averaged it down from 264 to 251. I would like to continue to do so, hopefully get it closer to the 240, 230 mark, because it is a very, very strong stock, and it does pay a very good dividend of, I think, 30 pence. So it's well over the 10% as is, although I would like to average it down slightly more to get a better return. I'm hoping to eventually, or within the near future, to have 330 shares of Aviva, which will then provide me with £100 per year of dividend income, and that's without capital gains. And as you can see, I mean, the average price of the Aviva stock, it is there's going to be a fair amount of capital gains there as well on the horizon. So I'll definitely be investing heavily into Aviva, trying to average down. I mean, if the price starts to climb again and starts to recover, that isn't a problem. I'll continue to invest. Just for as long as the dividend remains viable for me. So yeah, very strong stock, and I will be continuing to put money towards this one in the future. So the next one's BP. Now, both the oil majors here, BP and Shell, they were not part of my portfolio in the last video 3 weeks ago. Recently, the demand for oil has dropped significantly due to the coronavirus, and because of that, the share prices of all the oil companies have dropped quite a bit. So I mean, I've bought 100 shares of BP. They're currently at £3. It dropped even more in the past week or so. As I've been buying, I managed to get my average price per share at £3.08. Again, with the Aviva, I'm hoping to get this one to, in the near future, £100 a year in dividends, which it means I'll probably need about 300 shares. Again, 330 shares. So I'm going to continue to buy these while they're in their dips, try and get it as low as possible, hopefully get it closer to the £3 mark per share than £3.08. But even as is, I mean, it's still over that 10% mark for the dividend, and the capital gains, again, it's going to be quite high. It's currently at £3, but if you look back in time, I mean, it's more likely to be trading around the £5 mark. If not, I mean, if you're looking at the dips, the last slight oil crash, I mean, it's getting to the low £3, but again, that's nowhere near my investment price. And even if I'm not able to continue to average down, and my average price does increase a little bit, it's fine with me. I mean, this is a long-term stock. I'm quite happy to hold it for the sort of next 5-10 years, or as long as I possibly can, or as long as the dividends remain viable. So yeah, this is going to be a long term, and I'll definitely continue to allocate funds to this one. The exact same story for Shell again. I didn't have a position in this one prior to the last couple of weeks too. I've been buying it quite significantly since the oil drop. It's currently at £12. My average price is £12.78. So ideally, I would like to get this one down to down closer to the £12 mark if possible. Although again, I mean, it has dropped significantly. The capital gains possibilities there. So even if it is to climb slightly and I continue buying positions in it, I mean, I'm still far away from the sort of danger point where is it worth it for me to buy this stock, resting on the dividend to increase. Because I mean, you never want to buy a dividend stock that you buy, you're hoping for say 10% returns, and then let's say BT in the last 5 years, Vodafone in the last couple of years, for example. I mean, while you're retaining that dividend, your share price is just going down and down and down. So I mean, the dividend might be offsetting that loss, or it might not even be making up for it. So I mean, having that room for the capital gains and that assurance that you do believe it's going to increase in price again, it is an important thing. So yeah, I'll continue to buy into Shell. Hopefully, get the shares to the point where I can get £100 a year in dividend income. I think it's about £1.50 per share you get for a dividend. So I'll probably need somewhere around the 75 share mark. Although then again, after that, same with all the dividend stocks. Once they're at that point, I'll slowly increase them. Although at that point, there might be other dividend stocks available that they have a better outlook. So we'll see how that goes. Although again, a very long-term stock. Oil dips, it recovers. I don't think the age of oil is behind us yet, and far too much of the world still relies on it. So both these oil majors, they're going to be heavy parts of my portfolio. Lloyds, I've increased my shares from 225 to 751, and I managed to average down my price from just slightly under 32 pence to just slightly under 31 pence, which is a reduction of 3.13%. Now again, I'd like to get this dividend stock to that same metric, that same point that I'd like all of them to get to, which is £100 a year in dividends. I think that probably Lloyds are going to take slightly longer to recover from the coronavirus sort of downturn than the other companies in my portfolio will. This is due to the Lloyds price quite accurately reflecting the state of the UK economy. I mean, they'll have loans out, they'll maybe have mortgages out, they'll have a lot that rests on sort of cash flow, consumerism, and I think that probably they'll be one of the slower ones to recover. I still think it's a solid stock. You get a good dividend. I think the dividend last year was 3.2 pence. So I mean, it's over that 10%. I might possibly, depending on how market conditions are and depending on how the outlook is for the other UK banking stocks, I might possibly diversify slightly and possibly get shares in other UK banking stocks that also pay a dividend, just to sort of split the risk, or just in case one of the banks recovers significantly faster than the other. But again, it's a solid stock. I would like to get this up to the point where I've sort of getting £100 in dividends, which would be about 3,000 shares. So I'll gradually be increasing my position in Lloyds as well. I do think the outlook's good long term for the price that it's at. I mean, even if the capital gains only take you back to 50 pence, I mean, you do still have that wiggle room. You have that sort of moat around you when you're relying on dividend to know that you're not going to have any capital gains loss. So again, while the price is cheap, Lloyds is definitely going to be feature heavily in my portfolio. S&P 500. Now I've got quite good gains from this. I haven't increased my position since the last video. It's still only at 6 shares, and the share price that I've bought it for average is £20.89. Now I'm going to be increasing this one significantly. I'm going to be going through a stage of diversification over the next few weeks. That's probably going to be made up of purchasing more of S&P 500, buying into the Nasdaq too, and also using the fractional shares that are coming to Freetrade. They actually posted on the Freetrade community forum last week that they needed beta testers for fractional shares. Now they accepted the first 500 people, and I do believe I was within that first 500, so I should hopefully be able to use fractional shares in the next week, possibly 2 weeks, some point in May, definitely, because I know the first batch of 100 people have started using it. So yeah, the growth stocks are going to be split between the S&P 500, the Nasdaq, and also fractional shares that I'm buying myself. So say the tech stocks like Apple, Amazon, Alphabet, and we'll be buying small positions in those, gradually splitting it, and diversifying far more than I currently am. So while the S&P 500 right now doesn't make up a large portion of my portfolio, there will be far more funds allocated in the future. So that's all the ones that I've purchased in the past 3 weeks since the last video and in my first month of investing. Looking forward, I am going to be focusing a lot more on the growth stocks, which is going to be aided a lot by the fractional shares. I am going to be going for some more UK dividend stocks though to accompany those. I would like for eventually for it to have about 30% of my portfolio in dividend stocks. So the one that I've been looking at to purchase over the next few weeks, we'll just take a look at now. So HSBC, I've been watching them. I mean, their financials, they've not been great recently. I mean, they have had a lot of debt and there's a lot of layoff planned and everything, although again the dividend is good. They have lost a lot of their share price, which means you do have that leeway with the capital. You don't want any capital loss. I'll probably be monitoring them for a while, and possibly if the outlook is starting to look slightly better and the dividend yield is still quite high, then that is a possible candidate for accompanying Lloyds in my UK financial sector for dividends, although I'll be keeping an eye on that. Legal & General, I think this is a fantastic stock. I mean, they have a very good history of increasing their dividends. I haven't got a position in this, and I was actually kicking myself when I started buying into Aviva to not start buying Legal & General as well. I'm hoping they're going to get down to somewhere in the £1.80 something mark next week, and if they do, I mean, even if they stay at 196, I'm probably going to still take out a small position with them and slowly build it up, because I would like that diversification again, or not so much diversification. I mean, it's still an insurance, as is Aviva, although they do operate in slightly different areas. And I mean, for the growth of the dividend, Legal & General do seem like they have a better prospect. So yeah, I will be taking out a position in them and slowly growing it. Which other ones was I looking at? Now, BT and Vodafone, we'll take a look at BT here. Now, they both have a fantastic dividend. Their financials both aren't the best. They've both been taking a hit over the past few years. I do almost suspect that is coming to an end. I mean, their share price, there's not much more left to lose. I mean that's never the way to think, but I mean, I do think we've sort of reached this point where, I mean, it's going to stabilise slightly, and I mean, there may well be a slight dividend cut, although even taking that into account with the share price, you could still end up with a decent dividend paying stock here. It all just depends on where the share price is headed though. So I mean, I'm going to do a lot more research on BT as well as Vodafone. Vodafone's in a similar boat. They've both got very, very good dividend yields at the moment, although the from a capital loss standpoint, they haven't been the best performers over the past few years. I've been researching them both, and I do think it is looking slightly better for them now, especially with the price so low. I mean, it is more likely that it's going to sort of stabilise, and I do think they've sort of reached the end of their tough times. And I mean, out of the businesses that can thrive or even just remain sort of afloat during the coronavirus, I mean, there are two companies that will be affected far less. Telecoms, I mean, mobile data usage will be going up. I mean, internet and everything will be going up because everyone during the coronavirus they're using their devices more. They have more time on their hands. So I'm probably going to be taking out a position in one of these, or possibly both of them. I mean, I'm finding it quite difficult to decide between them. They both have their pros and their cons, so I might possibly just take out a split position in them and then see how they perform. Similar to how I was thinking about splitting the UK financial sector between Lloyds and another stock. So I'm likely to move into telecoms for dividends too. I think that's probably everything, yeah. So yeah, in the next couple of weeks, it's going to be sort of finally dipping my toes into growth stocks, getting more ETFs, more funds like the S&P 500, and also taking out some positions in probably Legal & General and the telecoms industry. So we'll see how it goes. I'll be making videos weekly now. I know it's been 3 weeks since the last one, although again, I did think it'd be slightly more interesting to wait until I had a better idea of where I was at, what I was going to be buying going forward, and I'll having a better selection of stocks as well, so it's not you guys just listening to me, right, I've bought this of that stock, nothing's changed, I've just increased positions. I mean, that's probably not the most interesting content, so it will be weekly now. There will also be videos of other things that I think would be of use to you, such as like the metrics that I use, or my thought process, or how it is that I select a stock, and what makes me think that it is a good choice. Although again, in this market right now, I mean, we've just had a massive dip. I mean, it is different sort of mentality than it would be in usual gradual investing. Although it'll be interesting nonetheless. I mean, it is a unique time right now, and any sort of exploration of how to work around that is, I'm sure, it'd be beneficial. So I hope you've enjoyed, and I shall see you this time next week.